Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Here is your starting lineup for the 3 in 10 podcast for Wednesday, September 17th, recording at 5 p.m. Eastern Daylight Time, shortly after the Fed's press conference. Number 1, retail sales beat forecasts on solid summer spending rebound. Number 2, the Fed cuts rates by 25 basis points, but the statement, the summary of economic projections, the dots, and the presser were full of contradictions and short on convictions. And number 3, are we beginning another leg down for the US dollar? We think so. So back to number 1, retail sales. They rose for a third consecutive month in a broad advance. We like to focus on the retail sales control group, which excludes food services, auto dealers, building materials, and gasoline stations. Those are the most volatile pieces of the data. And when you pull those out, we think you get a clearer picture of retail sales. And the number for August printed at a pretty strong plus 0.7%. That compares to the economists estimating positive 0.4%. So a solid beat, and also a beat of the prior in July of plus 0.5%. We saw that 9 out of 13 categories posted increases, led by online retailers. And the conclusion is we had a very solid back-to-school sales season. Consumers are still spending, despite tariffs raising costs of some goods and the labor market clearly softening. We've maintained for years that as long as consumers have jobs, they will spend. And they do have jobs. Yes, the labor market is cooling, but the unemployment rate is just slowly ticking up and is really still in the range that it's been in for the last 18 months. In addition, the Fed's 25 basis point rate cut this week should help to support the labor market at the margin, and we think there will be further cuts forthcoming between now and the end of the year. Number 2, the Fed. This was a risk management cut today because the Fed is worried about the labor market. That was the bottom line that came out of the entire press conference. If I was to distill it down to one thing, that was it. There is a clear two-way risk to both inflation and the labor market. And this cut was an attempt to balance the mandate. Chairman Powell said, to quote, "We have a wide dispersion of views in an uncertain environment." Very well put, I think. Powell also said that tariffs are causing goods prices, not services, but goods prices to rise. And the Fed's analysis leads them to believe that the tariffs are adding 0.3 to 0.4% to core PCE this year. Another quote, "Tariff pass-through has been slower and has taken longer to manifest in prices." That's absolutely true, and that surprised me and darn near everybody else this year, that it has taken a lot longer to happen. He said another thing that's very obvious, but really important. The U.S. labor force is no longer growing. Now, part of that is just demographics, and part of that is also that immigration has pretty well come to a standstill. And we know that labor force growth impacts everything. It impacts inflation, growth, the labor market itself. Powell strongly reiterated the 2% inflation target, but he did this in the context of cutting rates and raising the growth and the inflation forecast, which we see as quite contradictory. Powell rejected the idea put forth by Stephen Mirren of a third mandate. If you go back to the 1977 Federal Reserve Act, it is in there for moderate interest rates, but nobody's really ever known what that means. What is 4% moderate? Is 6% moderate? If you go back and look at the context of history, you could make a case that either of those numbers are moderate. So Powell rejected that, and probably rightfully so. The dots, as part of the summary of economic projections, are all over the place, but they do show a central tendency of a 3% federal funds rate by 2027. The market is way ahead of that, showing that 3% Fed funds rate coming much sooner. So once again, the market's way out ahead of the Fed, and we will see if the Fed is behind the curve or if the market is over-anticipating. But there's a huge dispersion of views on the Fed, with Mirren being the clear outlier dove, looking for 2.75% federal funds rate by the end of this year. That is not going to happen. And we thought the more interesting observation is that nobody followed Mirren to dissent, and not even Waller or Bowman followed him to dissent, even when they dissented last month. In fact, they backed Powell. Another thing we thought was interesting is that there was no mention at all of quantitative tightening, except in the statement where the Fed went on to say that they will continue quantitative tightening and they will continue to run their balance sheet off and shrink the size of that balance sheet in the background while cutting rates, which we also think is somewhat contradictory. So we continue to expect another 25 basis points of rate cuts in October and December, which will bring the federal funds rate down to about 3.5 on the lower end, 3.5 by the end of the year. That makes sense to us. Now, number 3, are we beginning another leg down for the US dollar? Well, the euro dollar currency hit a cycle high today at 118.50, the highest level in over 4 years. Fed rate cuts are leading to interest rate differential compression. So if you're going to hold dollars, you need to be paid to hold those dollars. And you've been getting a higher interest rate than you do in other currencies. In other words, there's a positive carry to the US dollar. When the Fed cuts rates like they did today, that compresses that positive rate differential. And in essence, investors or dollar asset holders are getting paid less to hold that US currency. So it makes the currency less appealing at the margin. I'd also maintain that confidence in Fed independence is falling. Mirren's dissent and his ridiculous dot of 275 by the end of the year underscores this point. Also, the Fed cutting rates and raising growth and the inflation forecast at the same time, we think hurts Fed credibility. The dollar is still expensive based on the traditional valuation models of rear and near. And let's not forget the uncertainty surrounding the legality of the IEEPA tariffs. These are the broad tariffs that Trump has put on virtually every country, a blanket tariff that may be illegal. And if it is, the U.S. could be forced to pay back over $200 billion in monies collected and blow a further hole in the federal budget deficit. So technically speaking, the downtrend remains intact. The dollar, in our opinion, is still in the middle of a historical devaluation. Year to date, the dollar's down about 10%. We think it's got about another 20 percentage points to go over the next couple of years, and we'll look back and see that the dollar devalued about 30% between 2025 and 2028. So as we always say, do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.